The dollar is going down versus the gold price and the silver price. I'm expecting by the end of the year, we're going to get past the $40 silver barrier, and you're going to be looking at all that silver behind you as worth a lot more.
We are in the next leg of a major bull market in the precious metals. Silver above 37 technically is very bullish, very strong, and but nonetheless, I think the trend is very clear.
I think we're going to have a real move in precious metals, and I suspect that the blow-off top in silver will be one for the record books.
Where we're heading, and that is to a monetary reset, which I do believe we are in the midst of right now. It's not that bang, it's the slow, methodical, where the dollar goes out with a whimper, not a bang, and maybe that's where we're going right now.
Well, I don't think there's ever really been a frothy top. I mean, there was a very brief moment when you could say that silver was a frothy top.
Its asset portfolio and leveraging the stability and value of gold bullion. The financing plan is part of a broader trend in the financial industry where traditional institutions are increasingly exploring the integration of real-world assets with digital financial instruments. By backing this project, Cantor Fitzgerald aims to enhance the liquidity and accessibility of gold bullion, making it more attractive to a wider range of investors. This initiative also aligns with the growing demand for stable and secure investment options in an increasingly volatile market. The decision to focus on gold bullion is particularly noteworthy given its historical role as a safe haven asset. Gold has long been recognized for its ability to maintain value during economic uncertainties, making it an ideal choice for investors seeking stability. By tokenizing gold bullion, the project aims to bridge the gap between traditional and digital assets, offering investors the benefits of both worlds. The $1.1 billion financing plan is a testament to the confidence that Cantor Fitzgerald has in the potential of this project. The firm's involvement not only provides financial backing, but also lends credibility to the initiative, given its extensive experience in the financial services sector. This backing is expected to attract further investment and support from other institutions and investors, further bolstering the project's prospects. Now we'll show you the best clips of the latest interview. Don't forget to like, subscribe, and turn on notifications so you do not miss out our daily recaps, and check goldsilverstacks.com to get your Stacker's Handbook, the ultimate guide to stack gold and silver, packed with strategies to trade the gold-silver ratio and get more ounces and build wealth over time, so you don't have to rely on market commentators to make your investment decisions. Enjoy the episode.
So they ask for the dollar to please perk up and rise. So that's what's coming next. And that's not what I look at. I look at the purchasing power, which is food prices, fuel prices, insurance prices, the cost of cable television, the important things. Okay, now, the dollar is going down versus the gold price and the silver price. I'm expecting by the end of the year, Chris, we're going to get past the $40 silver barrier, and you're going to be looking at all that silver behind you as worth a lot more. We're moving, I don't think, closer to an audit. I think we're moving closer to a gold standard. We don't need an audit of Fort Knox in order to institute a gold standard and a new dollar. It's going to be shoved down our throats. And I think we've got a transition going on right now where we need lower short-term bond yields in order to make sure that the Treasury bills are used in order to create collateral for the stable coins, which we didn't get into at all.
So I still think we're going to go sideways in gold through the summer. August is usually the weakest month for the metals, but overall very bullish, very happy, very pleased. I think the markets are moving at a pace that causes excitement, but not so fast that people will have the fear of missing out and think that, it's only going to last another month or two, because that's not the case in my view. It's going to continue. There will be some very sharp corrections that will scare people. But nonetheless, the overall trend is pretty clear. Commentators, some Kitco, some on LinkedIn, and other places talk about, the tier one aspect of Basel III. And I think Basel III is kind of overblown. I go back to the old market adage, buying the rumor, selling the news. The rumor's been out for a very long time, lots of commentary about it, and now the news is out there, it's enacted. So these analysts argue that Basel III is a bookkeeping reform, not a catalyst for gold buying mandates. Gold price remains driven, and it's really not. So if gold remains driven by liquidity, central bank buying, inflation, and macro factors. I mean, those are the same drivers that were there before Basel III. The reform looks like it could be explosive to boost physical holdings by bank, but that's really uncertain. Really, it's reduced some of the trading desk and consolidated things, but I think it's kind of a ho-hum at this point. I don't agree. Gold remains a tier one asset, which is bullish, not bearish. In effect, it's a gradual structural shift, not an overnight shock. Gold prices, again, remain tied to the gold liquidity, real yields, supply-demand fundamentals, and central bank policy. So it's not a no-brainer, but it's certainly not, I think, needs to be as hyped up as some others have said. It is significant. And I was looking at the dollar chart before we connected this morning, and, it looks to me like we're on our way to maybe 91 or so in fairly short order. I mean, the administration wants us cheaper dollar. I mean, basically any nation state wants their currency to be cheap because they get an advantage as far as an export advantage. So as Jim Dines used to call a race to the bottom, everybody's competing against everyone else to weaken their currency. And this is a very sad state of affairs, but the dollar certainly going that direction. And if you look at a long-term chart, I mean, dollar, the Dixie's been down to, I think, 70 or so. I'm doing it from memory. I just looked at a near-term chart before the call. But I do think that it's got more room to the downside, and it may mitigate some of the foreign exchange problems that other countries have paying back the U.S. in dollars. Because if it weakens on the dollar index, that means those other currencies against it are increasing. Because when you got to pay back dollars and they're more expensive in your currency, it makes it harder on these other nation states to pay back the dollar debt. So
in today's news recap, gold's tug of war, America cashes out, Asia holds the line. In the West, American retail punters are folding their gold hands like it's the final round of a Vegas cash game, tapping out after a gilded run, convinced that Trump's tariff circus is just smoke, not fire. Bullion dealers are swimming in American Eagles, premiums shaved down to deli slice levels, and sellers now paying just to offload. It's a garage sale in gold's heartland, a land where financial euphoria flows fast, but vault fees hit harder. Meanwhile, over in Asia, the tone couldn't be more different. Across China, India, and Southeast Asia, gold isn't a trade. It's trauma insurance. This isn't some Reddit-fueled moonshot. It's survival in a bar. These buyers aren't flipping. They're fortifying. Stacking gold isn't a flex. It's a family strategy written into generational DNA. The divergence is stark. Americans treat gold like a meme stock. Ride the hype, dump the bag, move on. Asians, they're loading lifeboats. When you've weathered currency collapses, coups, and IMF handshakes, a slab of metal in your drawer feels a hell of a lot more real than a brokerage app login. This is the 90-year-old tide of gold in motion, the ebb and flood between West and East. The West sets the price with institutional bravado, while the East waits with monk-like calm and gobbles up what the West discards. Prices rise, the West dishoards. Prices drop, the East reloads. It's not just a cycle, it's choreography. Don't mistake America's retail exit as gold's swan song. That's just the tide pulling back. The real move? China's physical demand up double digits. Southeast Asia posting 30% plus gains in bar and coin buying. While Western investors chase whatever's flashing green, Asia's quietly stacking. And here's the kicker. Even as U.S. retail pukes out ounces, central banks and sovereign funds are hoarding like medieval warlords. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button, turn on notifications, and check our new Numismatics Handbook. Most stackers want to get active, but swapping their metals for dollars isn't an option. There's plenty of opportunities in the overlooked numismatics world. Mastering U.S. coins, key dates, and errors pays off by multiplying your ounces and capitalizing where others aren't paying attention.
In essence, the Hunt brothers should have, the environment that the Hunt brothers tried to expose and exploit is exactly what you see right now. Far more contracts than bars backing it. And they bought up all the contracts and stood for delivery. They changed the rules. They being the exchange, which is owned by the banks, which will protect themselves. The difference is the LBMA is not an exchange. It's an over-the-counter exchange. There isn't a central clearing authority. It's peer-to-peer in essence. Me versus you. And if it breaks, there's no one there to step in per se, unless they get all of the members to do it. Whereas on COMEX, it's a different thing. It's a different animal. They can just, in essence, create a force majeure, shut it down, say no more deliveries, or do what they did in London when you saw the nickel problem. They just invalidate everything. We're getting to the point where that will happen, where whether it's outright default, it'll just be, it'll appear the exact same thing, and it will be settled in a manner where you would say, well, this was done to avoid a default. And, you know, I think that if we wait for that moment to happen, you can see that they're doing all they can right now to keep that from happening. We get to that point, yeah, if the COMEX were to default, the entire precious metals complex breaks down. And I think that ultimately where you will see things change is you're beginning to see the development and the maturity of other exchanges in Dubai, in Shanghai. You'll see the BRICS development of the BRICS Metals Exchange. You'll see the Moscow Exchange. These exchanges now in Singapore, these exchanges that are coming up throughout Asia in particular, and the BRICS network, will be more of a cash and carry, reflective of real price settlement. And it's almost like these players are trying to exploit as much as they can through delivery using the Western system until the Western system breaks. And whether it breaks by outright delivery default on one of the two exchanges is debatable. But I think in essence, whether we get to that point and see it or just realize it was inevitable before they came in and stepped in to protect themselves and changed the rules, the way they did under the Hunt brothers, where they said you can be as short as you want, but only long a certain amount, like 1 million contracts or whatever it is. And then anything over that amount, they were forced to sell. And that's what drove the price down. Now that is manipulation of the exchange to protect itself and screwed the Hunt brothers. Well, something like that I would expect would happen before you'd see one of these big banks blow up. But in London, no, I think in London you could see a default by a very large institution and there will be no one in there to step in to rescue. It's a fair question. I can't really answer it definitively, but simply to say it seems like we're getting closer and closer to that moment.
Well, I don't think there've ever really been a frothy top. I mean, there was a very brief moment when you could say that silver was a frothy top. Got up to what, sort of 37-ish, something like that. I mean, but really the reaction has been very, very minor from that frothy top. And the same with gold. I mean, gold sort of spiked up early one morning to 3,500, but I think it's just been moving sideways. And in these, as I was saying earlier, in these very quiet trading conditions, you would expect it to drift lower. I mean, I talk, if you like, as an ex-stockbroker. And, I knew that in the case of any stock, and it's the same has got to be true of commodities, in the absence of buyers, prices go down. Now, here we are with gold, close to all-time highs. You've got no interest in the market. I mean, really very little in retail interest, that is for sure, because everybody's just out there enjoying the weather. And this is what I found as a stockbroker in the UK. I mean, it was so frustrating the summer months because there was I on the floor of the stock exchange or in my office trying to contact clients to find that my competitors had taken them out to Ascot, Henley, all the sporting facilities. I couldn't get onto anyone and get them to deal because they were already being, wined and dined by my competitors. So it's the same thing now. Nobody's interested. And you would think gold and silver would drift off, but no, they're not. I think part of the reason is the weakness in the dollar. I think you've got to look at the dollar from the foreigner's point of view, always. They own, in terms of dollars and underlying financial assets, including about, I suppose, 7.5 to 8, or no, it's about 7 trillion of bank deposits, figure like that. Total is just under 40 trillion, of which I think about 14.5 is in equities. I mean, this is a lot of stuff to be sitting on when the dollar's going down. And the dollar from President Trump's if you like, Liberation Day on April the 2nd, dollar's lost well over 10%. So where have you made up the currency loss on your underlying investments? Well, the answer is you basically haven't. You might have done a little bit, I suppose, if you'd sort of continue to invest in NASDAQ type stocks, the Magnificent Seven, because they've performed reasonably well. But you're buying into hot air. I mean, come on. It's, the idea that these stocks are value, if you like, that's just nonsense.
I mean, I have a recent example. Kramer talked about uranium stocks yesterday. I'm terrified. If ever there was a sign you're overbought, it's Jim Kramer saying, get long. No, the truth is that I've learned over time an awful lot from reading a book called Human Action by von Mises about individual volition and the way people think. Their motivations around fear and greed and things like that, to love-hate, to buy things where the expectation is it merely goes lower. And after the narrative has been justified by the price action, when the narrative is no longer valuable, when the thing goes from fairly valued to overvalued to stupidly valued, and when everybody is buying into the narrative because the narrative has been confirmed by the price action, I sell some. I don't always sell all. Like I've never sold all my gold, as an example. I've ridden some position of my gold all the way back down. But as an example, Donegan, on your show about 6 months ago, I talked about the fact that the uranium juniors were stupidly oversold. Hated. A bunch of internet posters who had uranium as part of their internet handle were capitulating publicly, saying, I wish I never heard of this stuff. Doesn't get better than that. I bought a reasonable smattering of the high-quality uranium stocks. I already owned a lot, but I added on, not because I needed to add my position, but just because they were so hated. And now they're not hated anymore. And so those positions, which were between 20 and 25% of my total positions, I put back in the market. Is it likely to go higher? Yes, but that's not why I bought it. I bought it because it was hated. I bought it because it was oversold. When that condition ceased to exist, I sold.
What do you think of Morgan's take? Do you agree with him? Are you buying more gold and silver at these prices? Or on the contrary, are you selling like most other retails? Post your honest opinion in the comments section down below and share your gold and silver price predictions with the Stacker community. Now check out this next video right here because it's the perfect follow-up for you. I'll see you on the other side.